Hello and welcome to Business Incorporated. I am Bolaji Akinwale. Coming up on the program, the African Development Bank has approved the first tranche of $600 million for Nigeria. Facebook advertising revenues to drop in the next few months. Plus, Egypt's central bank floats currency, raises interest rates. Let's begin with the approval by the African Development Bank for the first tranche of $600 million out of a total $1 billion budget support package to Nigeria. The bank says that the second disbursement of $400 million would depend on the implementation of reforms by the present administration. This comes less than 2 months after the president of the bank, Dr. Akumi Adesina, announced loan facilities of $4.1 billion to Nigeria to finance critical sectors of the economy. The loans include $1 billion at a concessionary interest rate of 1.2% to address the 2016 budget deficit and aid the economic recovery. And still from the AFDB, the bank has approved a 900 million euros, that's $1 billion again, for Algeria, aimed at supporting reforms to help the North African nation confront falling oil revenues. According to a statement from the lender, the money will support the government's effort to improve domestic revenue mobilization and the investment climate, as well as boosting the efficiency of the energy sector and promoting renewable energy. The president of the Republic of Algeria, Abdulaziz Bouteflika, underlined that the economic and financial recovery of the country is within the country's reach and called for a national mobilization to join efforts in order to cope with the current financial difficulties. Now let's take you to the markets, starting from Europe, where the numbers were mixed this morning on continued concerns over the U.S. election, with investors also focused on the Bank of England's latest interest rate decision and fresh corporate earnings. So how is Europe trading at the moment in relation to the upcoming U.S. elections and the earnings reports that are being released at this time? Joining me from Frankfurt is Conrad Busen, DWTV financial correspondent. Conrad, thank you once again for joining me on the program. Now, the U.S. Federal Reserve says it was keeping its interest rate at between 0.25 and 0.5%. However, it sent stronger signals that unless a major event takes place before December 14, it is ready to hike rates. Now, this seems to be creating uncertainty as we draw closer to next week's U.S. general elections.
Absolutely, Bolaji. And you know, it's the words unless a major event might happen in the U.S. which make investors nervous. What kind of major event could that be? What kind of event could cause the Federal Reserve not to proceed with a monetary policy step it has been preparing for so many months now? Of course, I'm speaking about the expected interest rate hike in December. A major event, of course, points to the general election, the presidential election in the United States next week, and a potential outcome, a potential candidate, Trump, winning this election, which would, whoever you talk to here in the financial world, very likely trigger huge conundrums and nervousness among investors. It would weigh on markets heavily. So it's very difficult of course, to predict how long this nervousness and how those turbulences on the markets would be. But they have the potential, of course, to weigh on sentiment, on business climate, and actually on business activity in the United States. And that's why the Federal Reserve says, well, unless a major event happens, it might proceed with the interest rate hike, which is actually not something that people on the markets are very nervous. But still, as we don't know what the election outcome will be, investors keep away from the market. They keep rather passive. Look at the German DAX right behind me. There's no big movement, despite quite strong earnings reports we've been getting from many companies here today.
Now, the governor of the Bank of England, Mark Carney, is expected to present the central bank's latest quarterly economic forecast in an attempt to estimate the hit to Britain's economy from June's Brexit vote. How do you think his comments would weigh on the markets?
Well, you know, the economy held up quite well in the UK after the Brexit referendum, and inflation is rising in the UK. For next year, some experts predict that consumer price inflation in the UK might even rise as high as 4%. And if you look at, you know, what the textbooks say, the textbooks of monetary policy, such high consumer price inflation should normally have monetary policy makers hike interest rates, make credit more expensive in order to, you know, dampen price inflation. But in the case of the UK, of course, everyone knows that next year the Brexit procedure is about to start, and that's why it's quite unlikely that the Bank of England does anything comparable to rising interest rates. On the contrary, today it's decided to leave interest rates where they are, and most market participants will believe that the Bank of England is likely to do whatever it can to, you know, not have the economy in the UK slow down.
Now let's talk about the new mortgage rules for German banks. The new regulations have come under fire from critics who say they choke off the flow of home loans in Europe's biggest economy and represent an overreaction to the 2008 and 2009 financial crisis. Tell us more about this.
Well, first of all, I have to say that those concerns are a bit exaggerated, because the new rules that the government here wants to imply are meant to be implied only in a case of an emergency. What kind of emergency does the government have in mind? A bubble on the housing market here in Germany. And we've seen significant price increases for houses here in Germany this year, also the years before. But the German Bundesbank, which is our national reserve bank here, says this is not a bubble yet. One important sign, for example, is missing. The banks have not been given out mortgages recklessly. What the government plans is that if we are going to see signs of the bubble, the government wants to be having the potential power to implement rules that dampen mortgage businesses. What they want to prevent is that something happens like it happened before the Lehman collapse, before the last financial crisis, when in the United States banks gave out mortgages very recklessly to people who didn't have, you know, the potential to really pay back the mortgages. That's what the government wants to prevent, and that's what the rules are meant to imply.
Perspectives. Conrad Busen is DWTV financial correspondent reporting from the Frankfurt Stock Exchange. Still from the markets. In Asia, the numbers were mixed in early afternoon trade after a short-lived recovery as oil prices jumped nearly 1% and the dollar, that is the US dollar, weakened. The ASX 200 ended up 0.06% at 5,226.6, driven by gains in its gold sub-index, which was up 3.4%, and its energy sub-index, which rose 0.72%. South Korea's Kospi was up 0.39%, pairing earlier gains. The fourth largest Asian economy faces multiple domestic challenges, including a shipping industry restructuring, natural disasters, and a presidential crisis.
Existing can even survive this collapse. But you have Nigeria trading to, and I say to people, I say it's your informal economy, it's your informal trade, it's that sector that is still keeping the economy alive. So you must understand that. So government now comes and says, okay, first thing, need to grab this my foreign exchange. Good. Restriction. This you can't use foreign exchange for this. They had a list of that, etc., etc. Okay, the challenge is that you now have some problems with manufacturing because it affects some raw materials, like our friend said. But what we are saying, government, that okay, you have looked at the demand, but if you are not talking about the supply, then there is a problem. And the only way to grow that supply